All right, let's talk about a company whose products you definitely have in your house right now. I'm talking about the consumer goods giant Unilever. Today, we're going to tear down a really fascinating analysis to see if this huge company can actually deliver for investors like you and me. So here's the big question we're trying to answer. Is Unilever a safe, reliable dividend compounder? You know, one of those stocks that just keeps paying you and growing those payments over time? And can it actually deliver a solid 9% annual return? That's our target. That's the goal we're measuring everything against.
And before we get into the numbers, just take a look at this. It's almost hard to believe how many massive brands they own. We're talking Dove soap, Ben & Jerry's ice cream, Hellmann's mayo. These are things that literally billions of people use every single day. Their reach is just incredible.
Okay, so let's start digging in. First things first, before we can even think about investing, we have to understand what this company actually does. And maybe more importantly, what gives it its competitive advantage, what Warren Buffett famously calls its moat.
And the real genius of Unilever's business is just how simple and, well, boring it is. And I mean that in the best way possible. They sell things people buy over and over again, no matter what. You're going to buy soap and soup whether the economy is booming or busting. And that creates this incredibly stable, predictable river of cash.
So what's their moat? It's not just one thing, right? It's this powerful feedback loop. They spend billions on advertising to build brands we all trust. That trust means stores have to put them on the shelves. And because they're so huge, they can get those products onto shelves all over the world cheaper than anyone else. It's a fortress that's incredibly hard to attack. A great story is one thing, but you know what they say? Show me the money. Do the numbers actually back this up? Let's follow the trail and check out the company's financial health.
And right off the bat, things look pretty good. A profit margin of almost 19%. That's really strong. It means for every dollar's worth of stuff they sell, nearly 19 cents is straight profit. It shows they've got a real handle on their costs. Now, this next number, ROIC, this is a big one for me. It's basically a report card for the management team. It tells you how good they are at taking a dollar and turning it into more dollars. And a number over 17% suggests they're making some really smart decisions with their money. And this right here is what it's all about. Unilever is an absolute cash machine. We're talking over $7 billion a year in free cash flow. That's the cash that pays for dividends, buys back stock. It's the lifeblood of the company. And the fact that it's so steady is a huge, huge strength. So when you put it all together, you get this fascinating push and pull. On one side, you have an incredibly profitable, cash-gushing business. But on the other side, the analysis points a big finger at a major problem. Its growth has stalled. It's a classic mature company dilemma. It's great at making money, but it's struggling to make more of it. All right, so we've got a profitable company, but it's kind of stuck in slow gear, which brings us to the million-dollar question. What's it actually worth? It's time to talk valuation. So before we even glance at the stock price, we have to figure out the company's intrinsic value. Think of it this way. You wouldn't buy a house without getting it appraised, right? This is the appraisal. We're trying to figure out the true underlying value based on its future cash flows, completely ignoring the crazy day-to-day whims of the stock market. And would you look at that? The analysis shows that while the stock is trading for around $64, its intrinsic value is closer to 78. That gap, that difference between what you pay and what it's worth, that's what investors call a margin of safety. It's your built-in cushion if things don't go perfectly to plan. But of course, the future is never a sure thing, right? So a good analysis looks at a few different possibilities. In a worst case, or bear scenario where growth is super slow, the value is about $60. But in a really optimistic bull case, it could be worth as much as $95. Our base case sits right in the middle of that $78 mark. The analysis also gives us this weighted SWOT chart, and you can see the story right away. It's a total tug of war. The company's massive strengths are the heaviest weight, pulling it forward. But that big weakness, slow growth, is pulling back with almost as much force. And when we break it down, it's pretty much the story we've been telling this whole time. The strengths, those killer global brands. The weakness, that sluggish growth we keep talking about. The opportunity lies in growing in new markets, while the threat is always those cheaper store brands trying to steal customers. Okay, this is it, the moment of truth. We've looked at the business, the finances, the valuation. Now let's finally answer that big question from the beginning. Can we get that 9% return?
And this slide right here is probably the most important one of all, because it shows that hitting that 9% return isn't about luck. It's about discipline. You can't just buy this stock at any old price and hope for the best. To get that return, especially if you're a long-term investor, you have to be patient and wait for the right price.
So after all that math, all that analysis, it all boils down to one simple number: $60. According to this entire breakdown, $60 is the magic number for the long-term investor who wants to hit that 9% target.
And hey, don't just take my word for it. This source analysis from Save Invest Compound says it perfectly. A price closer to $60 gives you a much better risk-reward deal. Plain and simple. So, let's wrap this up. What are the big takeaways? 1. Unilever is a rock-solid defensive company that gushes cash. 2. It looks like it's modestly undervalued right now. 3. That slow growth is the big elephant in the room you have to watch. And 4, the most important one, getting that 9% return is all about buying at the right price. And this really leaves us with a big, interesting question for you to think about. In today's market, where everyone is chasing the next explosive tech stock, is there still a place for a slow and steady company like Unilever? Can boring still be a winning strategy?
It's something to seriously consider for your own portfolio. I hope you found this breakdown useful. And hey, if there's another company you're dying for us to look at, drop it in the comments below. We might just tackle it in our next one. Thanks for tuning in.